95% of day traders lose money. They approach the market like a casino, placing short-term bets and hoping to hit a jackpot. Online gurus fuel this cycle by selling the illusion of a quick buck. They claim you can predict the future by memorizing short-term chart patterns, but these movements are often little more than noise. Realizing a profit requires a shift in perspective. When you buy a share of stock, you are buying a stake in a living, breathing company. Identifying a healthy partner requires fundamental analysis, a methodical vetting process designed to uncover the reality beneath a company's public image. Lasting wealth is built by analyzing a company's foundational evidence, rather than trying to guess the direction of the next price fluctuation. The first document you need to pull is the balance sheet. This provides a clear snapshot of exactly what a company owns versus what it owes at any given moment. We start by isolating two categories. First, current assets, which is cash or items liquidatable within 12 months. Second, current liabilities, the debts the company must pay back within 1 year. This formula shows the ultimate survival calculation. By dividing total current assets by total current liabilities, we find the current ratio. For a company to be considered safe, that number should be greater than 1. Let's apply this to Coca-Cola's 2023 financials. They held $26.73 billion in assets against $23.57 billion in liabilities. That brings the ratio to 1.13. This ratio serves as a hard verification. It confirms if a company actually has the liquid capital required to meet its immediate obligations. But surviving isn't the same as succeeding. To see a company's track record of generating and spending money, we turn to the income statement. This data visualization highlights Coca-Cola's profit margin. By dividing their operating income by their total revenue, we see a margin of 25.7%, well above the standard benchmark of 10 to 20% for a healthy business. The final piece of quantitative data is the cash flow statement. This tracks exactly how money moves through the business operations, revealing the company's daily financial habits. This document often reveals significant red flags. For example, if a company is paying out high dividends to its shareholders while operating with negative cash flow, the business is on an unsustainable path. A company might look profitable on a spreadsheet, but irresponsible cash management will eventually exhaust its resources and erode your investment. Numbers only tell half the story. Spreadsheets cannot measure intangible shields like a dominant brand reputation or a deeply loyal customer base. A company's long-term stability is also tied to its executive leadership. Today, a single social media post can trigger an immediate billion-dollar swing in market value. In 2016, an erratic tweet regarding the cost of the F-35 fighter jet wiped out nearly $4 billion of Lockheed Martin's market value in a single afternoon. You must also look for a clear competitive advantage. These advantages are like gold for investors. Tesla established its dominance by building a proprietary supercharger network that its competitors could not easily replicate. Numerical data proves what a company has achieved in the past, but these qualitative moats dictate whether they can survive their competitors in the future. All this research is useless if you let emotions take over. The irrational selling of stocks during the bad news cycle is driven by the same hysteria that leads consumers to clear out supermarket shelves. Consider the Cambridge Analytica scandal in 2018. Reactionary fear caused Facebook stock to plummet 18% in just 10 days. But look at this line graph tracking Facebook stock. That sharp correction in 2018 was a temporary setback. Investors who trusted the objective data they had gathered held their shares and eventually saw gains exceeding 200%. The true test of an investor is psychological discipline, the ability to ignore media-driven volatility and rely strictly on the research you've already completed. To finalize your portfolio, you need to ensure you have a diverse range of stocks to balance things out. This means balancing volatile growth stocks with stable, dividend-paying value stocks, following the blueprint set by Warren Buffett. A robust portfolio construction follows a simple rule: allocate no more than 5% of your capital to any single stock, and ensure you are spread across at least 5 different sectors. Once you establish this balance, you should only exit a position for 3 reasons: a personal financial emergency, hitting a specific life goal, or a total breakdown in the company's financial health. Long-term wealth is the result of doing the forensic work up front, maintaining a diverse portfolio, and allowing time to multiply your gains.